Welcome to the Deep Dive, the show where we try to cut through all that noise and really find the key insights just for you. Today we're doing a deep dive into Dixon Technologies, specifically their Q1 FY26 results and some pretty big strategic moves they're making. You've given us a lot to work with here: the earnings call transcript, financial reports, analyst questions. It's quite the stack.
Yeah, it really is. And our job basically is to unpack all of this. We want to get beyond just the numbers, right? We need to understand the why behind Dixon's performance, what these strategic shifts really mean for their future, and maybe for the whole electronics manufacturing scene in India. We'll focus on pulling out the really critical takeaways from everything you sent over.
Okay, let's dive straight in then, kicking off with the headline figures for Q1 fiscal 26, so that's the quarter ending June 2025. It looks like, well, an absolutely stellar start to their year.
Stellar is definitely the word. Looking at the consolidated numbers, revenue from operations hit 12,838 crores. Now that's up a huge 95% year on year. Compare that to 6,588 crores in Q1 last year. Just massive growth.
95%.
Yeah.
Wow. And what about profitability?
Also very strong. EBITDA, that's earnings before interest, taxes, depreciation, and amortization, came in at 484 crores. That's an 89% jump from 256 crores last year. And the bottom line, profit after tax, or PAT, that doubled. 100% year-on-year growth to 280 crores from 140 crores. Profit before tax, PBT, also really strong, up 103% year-on-year at 366 crores.
Incredible growth funds all around. But, beyond just the sheer size of the increase, what does this tell us about how the company's actually running, their financial health, discipline? Are these numbers solid?
That's the key question, isn't it? And the underlying indicators look pretty positive, too. Take their net working capital days. It stood at -4 days, -4.
-4. So wait, that means they're getting paid by customers before they have to pay their own suppliers.
Exactly. It's a sign of really, really tight working capital management. Very efficient. And their balance sheet looks strong, too. Net debt is actually negative at -214 crores.
So more cash than debt.
Precisely. And look at the return ratios. Return on capital employed, ROCE, was 49.1%. Return on equity, ROE, was 33.9%. These are as of June 30th, 2025. These aren't just numbers on a page. They show Dixon's really good at turning the capital they have into profit. It guides how they allocate future investment, too.
Okay, and cash flow. That's always critical.
Right. And free cash flow was positive at 57 crores. That's a big turnaround from Q1 last year when it was negative under 24 crores. So the operations themselves are now generating cash, which is, fundamental.
Okay, so a really strong overall picture. Let's peel back the layers now. Where's this growth actually coming from? If we break it down by business segment, what stands out? Any new developments?
Absolutely. Let's get into the segments. First up, mobile phones. This is still the absolute powerhouse. Revenue hit 11,663 crores. That's 125% year-on-year growth. Massive. Operating profit also surged, up 121% to 395 crores. Dixon is solidifying its position as the largest domestic manufacturer here.
And it looks like the momentum's continuing.
Yeah, they're indicating strong momentum. The Q2 order book for FY26 looks even stronger, and they're expecting at least 15% volume growth just quarter on quarter. Just in Q1, they turned out 9.66 million smartphones and 5.73 million feature phones. Huge volumes.
And they're building capacity to match.
They are. That big Noida campus they're building, 8 million square feet dedicated to mobile manufacturing, is apparently progressing well. Expected completion is March 2026. Their future target, and this is excluding any potential share from the Vivo JV we'll talk about later, is something like 43 million units annually.
Okay, so mobile is clearly, as you said, the powerhouse. But they're diversifying too, right? That push into consumer electronics, especially refrigerators, seems like a big story.
Yeah.
How are they gaining market share so quickly there?
You're right. It's definitely worth highlighting. That segment, which includes LED TVs and refrigerators, brought in 672 crores in revenue. And the fridge business specifically contributed 328 crores of that.
Significant.
Very. The outlook for LED TVs in Q2 also looks good. Healthy order book. And interestingly, about 72% of those TV sales will be ODM solutions.
Meaning they design and build for other brands?
Exactly. They're not just assembling to spec. Now, on refrigerators, it's quite remarkable. They've apparently grabbed around 10% market share in the direct cool category within just 1 year. That's fast. And they're doubling down, expanding capacity from 1.2 million units to 2 million. Plus, they're adding new product types. Cross-door, side-by-side fridges, even mini bars, deep freezers, veggie coolers.
So a much wider range.
Definitely. They sound pretty confident about hitting 50% growth in the fridge business this fiscal year. Longer term, they see it contributing, maybe 2,000 euro, 2,500 crores in revenue in a couple of years. Meaningful scale.
What about their other home-related businesses? Home appliances, lighting, similar expansion plans.
Yes, similar themes. Home appliances revenue was 313 crores, up 13% year on year, with a decent operating margin around 11.5%. They've got a capacity expansion in Tirupati that should be ready by August 2025, so very soon. Product-wise, they've launched bigger washing machines, 16 and 18 kilograms semi-automatics hitting the market in Q3, and a new partnership with Eureka caught my eye, manufacturing robot vacuum cleaners. Another diversification play.
Interesting. Robot vacuums.
Yeah, and they've also got a project for load washing machines, apparently led by a senior expert they've brought in from Korea. The revenue target for washing machines overall is to grow it from around 1,200 crores now to maybe 1,800 to 2,000 crores.
Okay.
Yeah. Lighting revenue was 188 crores in Q1. The big news here is the 50-50 joint venture with Signify. That's the company behind the Philips brand. That JV officially kicks off in August 2025. The focus is on premium lighting, professional stuff, and also exports. They mentioned securing a pilot order already from a major U.S. retail chain for strip and rope lighting. If that scales up, it could be significant. The goal with this JV is basically to double their lighting business revenue from around 850, 900 crores currently to 2,000 crores.
So it seems like almost every segment has a major growth or expansion story. What about telecom and networking and IT hardware? These feel like big potential areas too.
Huge potential, and the numbers show it. Telecom and networking products had incredible growth. Revenue hit over 1,410 crores. That's over 250% growth year on year.
Wow, what's driving that?
Mostly India's broadband boom, fiber to the home, and also the rise of 5G fixed wireless access devices, people needing better home internet. They're also doing some backward integration here, starting to make components like mold links and adapters locally. The target for this segment, 5,000 crores in revenue in, they say, a year or so. Very ambitious.
And IT hardware. Laptops, tablets.
That's right, IT hardware products.
Yeah.
They've got a dedicated unit in Chennai now. It's already started mass production for big names like HP and Asus. And they mentioned the Lenovo order book is picking up too, so expect strong revenue growth there.
Wearables, hearables,
Yeah.
smaller segments but growing fast globally.
Yep. Wearables and hearables brought in 175 crores. They've added dash cams and smartwatches to their portfolio for existing clients. Again, focus on backward integration, making more parts themselves. Strong order book reported there too.
Okay, and finally, Dixon Electronic JM. That's a JV.
It is. Their JV focused on manufacturing services. It hit its highest ever quarterly revenue, 144 crores. They're actually setting up a new manufacturing freight in Chennai for JMM2 because of increased orders. That should be running by Q4 of this fiscal year.
Okay, this is an incredible amount happening across the board. It really underscores this shift you mentioned, moving beyond just assembly towards deeper backward integration, making their own components, and all these new joint ventures. What's the bigger picture here? What's the real strategic significance of these moves? I mean, managing this kind of aggressive expansion must have its challenges too, surely.
Absolutely, that's a critical point. This isn't just growth, it's a strategic transformation. What ties all these JVs and component plays together is Dixon's clear aim to, well, control more of the value chain. They want to secure supplies of key components, lock in future demand from major brands, and basically capture more profit margin. It's a fundamental shift for made-in-India electronics. You can sort of categorize these JVs into maybe 3 buckets: securing critical components, consolidating their core manufacturing scale, and expanding into related high-growth areas.
Okay, let's break down some of the key ones then. The component JVs seem particularly important.
Definitely. Let's start with QE India. This is for camera and fingerprint modules. Dixon's taking a 51% stake. Now, QE is apparently already a top 5 global player in camera modules. They supply brands like Vivo, Oppo, Xiaomi, Motorola right here in India.
So an established player.
Right. And the Indian market for camera modules is huge, maybe 475 million units a year. Phones have multiple cameras now, QE India did nearly 2,000 crores in revenue last year from about 40 million modules. But here's the kicker. Dixon expects its own internal need for camera modules to hit 180, 190 million within 2 years.
So huge potential for in-house sourcing and margin improvement.
Exactly. They're targeting 5,000 crores in revenue from this JV over the next 4 or 5 years. The investment is around 400 crores for the stake, plus another 150 crores for expansion and deeper manufacturing. They reckon this move alone could boost their overall EBITDA margins from the current 7.5% range up to maybe 8.5, 9.5%, especially with PLI benefits kicking in.
Okay, that's cameras. What about displays? Another key component.
Yes, the HKC Display Modules JV. This is a 7/4/26 venture with HKC, another top 5 global player, this time in display fabs. Phase 1 capacity is planned for 2 million mobile displays per month, expandable to 4 million plus 1.8 million notebook displays. Interestingly, they mentioned the production lines are adaptable for automotive displays to bikes and cars, and they're even looking into a TD display module line.
Very versatile. What's the cost and timeline?
Estimated capex is about $130 million spread over time. Trials are expected in Q4 of this fiscal year, FY26, with mass production starting Q1 FY27. And the margins here, they're expecting higher double digits. Very profitable potential.
So they're moving way down the supply chain, cameras, displays, not just making phones, but making the critical parts inside the phones.
Yeah.
That feels like a major step towards self-reliance, doesn't it?
It really does. And then you have the JVs focused on the core mobile manufacturing itself. There's the Longcheer JV. That's a 7/4/26 split for a big mobile manufacturing campus. They're expecting PLI approval for this one soon. This JV does a few things: strengthens the relationship with Longcheer, secures business after the current mobile PLI scheme potentially winds down, deepens their manufacturing tech, and broadens the product range beyond just smartphones. It even includes setting up a joint design center. The idea is that Longcheer's existing India volumes, estimated somewhere between 25 and 51 million units, will shift into this JV.
Okay, and then the big one everyone's been talking about, the Vivo JV.
Right, the Vivo JV. Dixon's taking a 51% stake in Vivo's Indian manufacturing arm. PLI appraisal for this is apparently going well. Approval's expected within about a month. Now, Vivo has a huge market share in India, around 22%. That translates to maybe 35 million phones a year. The plan is for about 2/3 of that volume, so maybe 20 million units to be made through this JV. This adds enormous scale to Dixon's operations almost overnight. It's a potential game changer.
Absolutely huge scale. Any other notable JVs on the component side?
Yes, a couple more. One with Chongqing UI. This is a 7/4/26 JV focused on precision components, mechanicals, metal parts, initially for notebooks, but potentially extending to smartphones. They'll be applying for PLI under the ECMS scheme. That's the Component Focus Incentive Scheme. Estimated investment is about 100 crores. Again, expected margins are robust, double digits. And finally, the Inventec JV for IT hardware, a 60/40 venture with Inventec, who are one of the world's top 5 PC ODMs. This covers notebooks, servers, desktops, should be operational by Q1 FY27. The idea here is to leverage Inventec's expertise, and interestingly, Chongqing UI, the other JV partner, is actually a vendor to Inventec, so potential synergies there.
Synergies and more backward integration.
Exactly. They're even exploring opportunities in SSDs and memory modules through this connection. So if you add all this up, the total capital expenditure outlook for this fiscal year, FY26, is pretty significant. Around €11, 150 to 1,200 crores. They've already spent 287 crores in Q1 alone, covering both organic capacity expansion and these strategic acquisitions and JVs.
Wow. That is an incredibly ambitious, complex, and, well, expensive plan. It makes sense strategically, but with so much happening so fast, new factories, new JVs, new technologies, questions must be swirling. How are they planning to manage it all? What about life after the big mobile PLI scheme ends? Did management address these sorts of key concerns in the earnings call?
They did, and the Q&A part of the call was quite revealing on these points. A major question, as you said, was about the post-PLI strategy for mobile. The main PLI scheme is set to expire after FY26. Management outlined a kind of three-pronged defense, if you like. First, they believe their deep relationships with customers will endure. Second, the sheer scale they've built will give them operating leverage, basically, lower costs per unit.
Spreading fixed costs over massive volumes.
Precisely. And third, this aggressive backward integration into components, cameras, displays, mechanicals is designed to capture margin that can offset the loss of the PLI incentive. They sounded quite confident that these factors combined will keep them more than competitive, even without the PLI boost.
Okay, that makes sense. What about growth outside of mobile? Are those targets realistic?
They gave specific projections for the key non-mobile businesses. Telecom target: 5,000 crores in about a year. Refrigerators: 2,000 of 2,500 crores in a couple of years. Washing machines, aiming for 8,000 in under 2,000 crores. And lighting, doubling to 2,000 crores via the JV. It shows a very clear strategy to build other strong pillars alongside mobile. Diversification is key.
But can the management team handle this pace? That's a lot of balls to keep in the air.
That question definitely came up, management bandwidth. They acknowledged the aggressive path. They highlighted several key senior hires they've made recently: a VP for strategy and digital transformation, a VP specifically for components, an expert brought in from Taiwan for the display manufacturing venture, a Korean expert for washing machine R&D, and a new VP of HR. So they're actively trying to bring in the expertise needed to manage this expanded footprint.
Right. There was also some confusion about their CCTV business.
Yes, they clarified the CCTV business. Basically, Dixon merged its CCTV operations into another company, Adity Infosh, a while back. Dixon now only holds a small minority stake, about 6.5%. Adity Infosh is apparently planning an IPO, but Dixon isn't actively running that business anymore. They've effectively exited direct management.
Okay. And what about making PCBs? Printed circuit boards? Are they planning to get into that?
On PCB manufacturing, they said, for now, no. At least not for bare PCBs. Their reasoning is there's a global surplus capacity, and critically, there's no duty protection or incentive because it falls under the ITA-1 agreement, an international tech agreement ensuring zero tariffs. So the economics aren't compelling for them right now. They remain focused on other components, though they did mention maybe exploring PCB assembly, PCBA, for industrial or automotive use later on.
Got it. And exports. They mentioned targets there too. How significant is that becoming?
The export opportunity is definitely growing. They said the selling price for exports to their main customers is currently similar to domestic prices, although the initial costs to ramp up export operations are a bit higher. Exports were about 1,600 crores last fiscal year. The target for this year, FY26, is around 7,000 crores. That's a massive jump.
Huge jump.
And potentially 11,000 crores by FY27. They specifically mentioned they're already exporting to Africa. So global ambition is clearly part of the plan.
Okay. And putting it all together, scale components, PLI, changes. What's the overall outlook for their profit margins?
They addressed blended margin expansion. The expectation is for overall margins to increase by about 120 to 130 basis points. That's 1.2 to 1.3 percentage points in FY27, even with the mobile PLI tapering off, and potentially further expansion in FY28.
And that's driven by?
Driven by that operating leverage from scale, benefits from the other PLI scheme, the ECMS for components, and crucially, the higher margins they expect from making their own components. They specifically called out that display modules and the mechanical parts for laptops should yield double-digit margins, with displays potentially being even higher. That could significantly lift the overall profitability profile.
So it really is a story of building incredible scale, but also moving strategically up the value chain. Dixon seems to be transforming itself from primarily an assembler into, well, a much more comprehensive electronics ecosystem player.
Yeah.
It sounds like a strategic masterclass unfolding.
It really does, and it leaves you thinking, doesn't it? Considering this aggressive backward integration, this vast network of JVs, what does this really mean for the future of Made in India electronics? And maybe even more broadly, how will this complex web of partnerships that Dixon is building potentially reshape the global supply chains for phones, laptops, and other consumer devices in the years ahead?
That is indeed a thought-provoking question for you, our listener, to mull over. Thank you for joining us on this deep dive into Dixon Technologies. We hope you found it insightful, and we encourage you to keep exploring these fascinating developments.